Welcome back to Nomad Investing. Today we are diving into Adobe, ticker ADBE, the software giant behind Photoshop, Acrobat, Premiere Pro, and the Creative Cloud subscription model. Now here's the thing, Adobe's stock has not been performing well. In fact, it's nearly down 40% over the past year. But why has the stock fallen so much? Stick around until the end, because I'll explain the key reasons behind this drop and what it means for investors. We'll go through the company's business, its financials, the future opportunities and risks, and finally calculate an intrinsic value to see if Adobe's stock is a buy at today's price. Overview. Adobe is one of the leaders in creative software, digital marketing, and document management. Its business is split into three main segments. Digital media, this is the largest segment, including Creative Cloud apps like Photoshop, Illustrator, and Premiere Pro, along with Document Cloud products like Acrobat and e-signatures. Next segment is digital experience, marketing analytics and customer experience software that helps businesses manage and grow their digital presence. Lastly, print and publishing, a smaller segment but still relevant. It includes legacy software solutions for printing, publishing, and e-learning. What's unique about Adobe is its subscription-based business model. Instead of selling one-time software licenses, they move to recurring subscriptions, which now provide steady and predictable revenue streams. Financials. Adobe stock trades at around $350 per share right now. Over the past year, the stock is down about 40%, which is a huge drop. Forward EPS estimates are around $20.50, giving Adobe a forward PE ratio of around 17, which is quite a bit lower than the historic average. The company's market cap is around $150 billion. Adobe doesn't pay a dividend, so investors rely on growth and buybacks for returns. Short interest is somewhat elevated. Revenue per share grew steadily from around $9 in 2012 to over $51 TTM. That's more than a 5x increase in just over a decade. EPS followed the same trend, moving from around $2 in 2012 to about $15 TTM. Free cash flow per share has been particularly strong, reaching about $21, which shows that Adobe generates plenty of cash. Margins are also very healthy. The operating margin has consistently been in the 35% range since 2020. The profit margin is currently about 30%. On the balance sheet, long-term debt stands about $6.5 billion, while the total equity is around $11 billion. So Adobe is leveraged but not excessively. Future. Let's start with the opportunities. Adobe is investing heavily on AI tools like Adobe Firefly for generative AI, which could bolster growth and keep its creative suite central to content creation. Its subscription model provides predictable recurring revenue, a big plus during economic uncertainty. The digital experience segment is growing, positioning Adobe well in marketing, analytics, and digital workflows. Expansion into cloud-based workflows and collaboration tools enhances enterprise stickiness and productivity. Risks. Slowing growth. Adobe's share price is down nearly 40% over the past year. This reflects both a deceleration in growth and a broader market discount on software companies in a high-interest environment. AI disruption. Free and low-cost AI tools are cropping up rapidly. While Adobe is integrating AI, there is real risk users might migrate to cheaper, more flexible alternatives. Competition. Adobe leads in creative tools, but faces stiff competition in the digital experience space from players like Salesforce and HubSpot. Winning here will demand constant innovation and investment. Subscription fatigue and damaged reputation. Adobe has drawn criticism and even regulatory action for its aggressive subscription enforcement. An FTC lawsuit alleges that Adobe hides hefty early termination fees in fine print and makes cancellations difficult. charging up to 50% of the remaining year's payments if cancelled late in the first year. Consumers report being trapped in long-term subscriptions, forced through multiple hoops to cancel, or even still charged despite apparent cancellation. I have been personally annoyed by this. I wasn't able to cancel my yearly plan without paying a fee first. Since the yearly plan with monthly payments was discounted, Adobe charged me a penalty when I tried to end it early. It feels unfair, and the way Adobe handles this really isn't the right approach. Even small adjustments to the subscription model could make the experience much better for users. At this rate, I think many users might turn to pirated versions of the software, or if a competing product with similar quality and fairer prices emerges, people would quickly switch away from Adobe. Intrinsic value. Adobe's forward EPS is estimated to be around $20.50, with analysts estimating around 10% growth rate. I believe this is a fair estimate, assuming no major market disruptions. To be conservative, I'll project a 9% growth rate for the next 5 years, followed by a 6% for the next 5 years. And my required rate of return remains 12%. Historically, Adobe's price-to-earnings ratio has been high, typically ranging from 45 to 50, with the median of 49. Given the estimate of 10% growth and growing user dissatisfaction, a PE ratio this high is not justified. While Adobe still has a super sticky recurring revenue, a more conservative PE ratio of 19 seems fair. Based on these numbers, the target buy price is approximately $430, which suggests that Adobe is currently undervalued. Adobe is high margin, cash generating business with a dominant market position. While competition and slowing growth are real risks, its subscription model and investment in AI keep it relevant. My primary concerns are the increasing negative user sentiment and potential disruptions from AI. While I believe a significant AI threat is still some time away, the widespread dislike for their monetization model is a real issue. Still, Adobe's wide economic moat, offering a complementary suite of products, means it's not going anywhere soon. For now, Adobe remains on my watch list, but I'm not buying it due to the concerns of maybe losing money on the investment. Maybe I'll revisit it when it drops below $300. And remember, this is not financial advice, and do your own research. If you agree with this analysis, hit the like button. If you think I'm crazy, leave a comment and tell me why. And while you're at it, subscribe so you don't miss my next video. Thanks for watching, and as always, do not lose money and safe travels. Bye bye.